Welcome to the new series of videos on equity investments for the 2027 curriculum. There are changes, of course, from the Level 1 2026 curriculum, hence we're doing new videos on this specific topic, starting with something which for a vast majority of you I think will be quite simple, namely the basic features of equity instruments, i.e. shares. So as always, I recommend that you first download the relevant note template. It has quite a lot written on it, but we will be writing on this, filling in the gaps. There's lots of things to write here still, but the idea behind the note is to simply save time and not have to write everything out. So as you can see, equity instruments, also known as shares, are basically a standardized form of company ownership. They're a tool for owning a company, but very importantly, not the entire company, but what is critically going to be a fractional stake, a fractional part, a fractional piece. A piece is always fractional unless it's the whole thing, right? It's 100%. A fractional stake in the issuer being the company. And a company typically has numerous shareholders, each owning a part of the business. And this is where, we need to also talk about the advantages of a company issuing shares and being a company that issues shares, as opposed to being just a sole proprietorship, meaning the sole ownership of a specific person, a family, etc. First of all, shares are transferable, so they allow us, or they allow their owners, to sell shares, part of their portfolio, and get money for it, increase their ownership of the business as well. So transferable. Of course, in reality, from a legal point of view, transferability, let me just write this down properly. In reality, okay, I wrote transferability, but I wanted to say that shares are transferable. That's the adjective I wanted to write down here. In reality, it's possible to come across shares that are non-transferable, but most of the shares you'll be dealing with are transferable indeed. Now, very importantly, and this is a huge advantage over running a business as a sole proprietorship as opposed to a business that issues shares, is that shares offer what we call limited liability to the shareholders. Namely, the shareholders are not typically going to be liable for any money in excess of what they've put into the business. That's the maximum they can lose. Whereas if you run a business as a sole proprietorship and things go, belly up, things go bad, you can stand to lose not only the money that you invested into the business, but also your personal wealth outside of the enterprise. And what's also very important here is that shares allow for access to additional external capital. So with shares, it's typically going to be quite easy to issue more of them, and therefore attract more money into the business, get more capital, which is not necessarily going to be true. Definitely, actually, is not true if you run the business as a sole enterprise, a sole proprietorship. Okay, the curriculum is quite big here on you being able to make comparisons of equity instruments, so shares, with debt securities. So I've created this kind of template here where we're going to outline the features of debt and equity across certain dimensions. The first of these dimensions being maturity. If you've already studied fixed income, or parts of it at least, you will know that debt securities typically have a defined maturity. So the maturity here is typically defined. We know when bonds, notes, etc. of companies or issued by companies are going to mature. And that's when the company should pay back the debt. Obviously, of course, there is the possibility to come across debt without a defined maturity as well, so-called perpetual debt. But that's a very small sort of piece of the entire debt universe, especially with corporate debt. Now, for equities, we're going to typically have indefinite lifetimes, meaning that equities do not generally mature. Generally, there is, sometimes going to be a maturity date with preferred shares, but with ordinary normal shares, not so much. That's not the case. Although we will come to the differences between so-called ordinary and preferred shares at the end of this recording, as well as in the next one. So shares go on, or their life continues all the way until company liquidation. So when the company ceases to exist, that's also when its shares cease to exist. Alternatively, what may also happen is that an existing business may get acquired. So there may be an acquisition, and basically the existing shares may be bought up by somebody else, and effectively the company the company, which until now existed as a separate enterprise, may get merged into something bigger, and it will no longer, those shares will get cancelled. There may also be some kind of restructuring which causes those shares to stop existing. But generally speaking, if the company continues to function as a standalone business, its shares should go on. Now, another important dimension across which we see big differences between, or observed differences between debt instruments and equity instruments is the potential obligation to make payments. With debt instruments, the issuer, in this case we're talking about corporate debt or corporate issues, so that the issuer is going to have a contractual obligation. Contractual obligation basically stemming from a contract between the company and its debt providers, its debt holders, to do typically two things: to repay the capital borrowed. So for the repayment of capital, that's one part of the obligation, you have to give the borrowed money back. But on top of that, typically, you're also going to have to make periodic payments of coupons or interest. Periodic coupon or interest payments. If you've already studied some fixed income, you will know about this very much. And if you're generally interested in finance, you probably know about this as well. So two types of obligations which are contractual, meaning if a company does not do this or this as stipulated in the agreement, it goes into what's known as default, and various legal ramifications of that, or various legal consequences will follow, and they're not nice nice ones. With equity, the company or the issuer has absolutely no contractual obligation to make any payments, although typically companies, at least some type of companies, typically do make payments, but they don't constitute an obligation. They pay things like dividends, which are expected by shareholders or owners of the equity instruments, but there's nothing forcing them to do so, other than maybe just the expectations of the shareholders and the market at large. Right. Now, over here, I've basically drawn up or written up the very beginnings of a typical P&L, a typical profit and loss statement. Once again, if you know a few things about financial reporting analysis, you will recognize this as being the first component of the P&L, profit and loss statement, starting with the company's sales revenue, how much money it makes from sales, minus the various costs that are associated with sales, the cost of the goods that were sold, but also various so-called overheads. So more general expenses, admin, keeping the marketing department, the sales department. Those are sales general and admin expenses, SGA sort of expenses. And once you deduct these two from your sales revenue, meaning this and this, you arrive at EBIT, which is your earnings before interest and taxes, also known as operating income or operating profit. Right. Now, what happens with EBIT, or what goes below EBIT? I'm going to say here that our focus is on certain periodic distributions. If a company has debt outstanding, and most companies have both equity investments into them coming from the shareholders, as well as at least some debt as well. It's very difficult to find companies that are not indebted in one way or another. And one of the things that debt providers expect on a periodic basis is the periodic receipt of coupons or interest payments. This is, after all, as we said, a contractual obligation of the company to provide such payments. So these periodic coupon payments will be charged against EBIT, or they will be deducted from EBIT as interest expenses or interest payments, interest expenses. Actually, let me say payments. As a negative charge. After that, you will also have to pay taxes. And in most places, at least, you pay taxes on an after-interest basis. So the payment of interest reduces your tax liability, your tax obligation, your tax base, meaning the more interest you pay, the less tax you have to you compute and pay to the tax office, because interest in most countries around the world is a tax-deductible expense. And it's only then, after this charging of the taxes, that you will arrive at the company's net income, right? The bottom line, the net profit or loss, the net income, after interest expenses or interest payments have been deducted that go to the providers of debt. And it is this net income that subsequently may then be used to perhaps make a payment to shareholders, right? It's out of net income that a company may decide to pay some money to shareholders, the providers of equity capital. But there is no contractual obligation, let me emphasize that again, for equity to do so. It's at the discretion of the company to make a payment or not to its shareholders. Now, shareholders may have an expectation that they should receive a dividend, but how much and whether they receive a dividend at all is not a contractual obligation. So from this net income, basically two things may happen, or with that net income, two things may happen. And actually, in reality, they both happen kind of simultaneously, because part of the net income, what a company will typically do is they will transfer a part of the net income to what we call retained earnings, meaning these are the earnings, the profits that are going to be retained by the business. So we typically say they get reinvested into the business, therefore allowing the business to basically grow organically. Whereas the rest, but once as I say, there is no obligation to do so. A company may transfer 100% of its net income to retained earnings, and this is what typically happens with companies that have already have profits but still have big growth opportunities. And it's typically decided then that it's quite a good idea to allow the company to keep growing and therefore transfer the profit generated to retained earnings to accumulate more and more capital for growth and feed that growth. But in reality, what happens a lot of the time is at least part of the profit or income generated is used to pay dividends. And it's dividends that are the periodic payments to equity providers. Once again, emphasizing the fact that the company does not have a contractual obligation to pay any dividends. They are therefore discretionary. At the discretion of the company, distributions of net income to the shareholders, the providers of equity capital, and don't treat this, these two arrows, these two green arrows going to retained earnings and dividends as a sort of either or situation. In reality, it's typically the case that there is a certain policy within the business to retain some of the income within the business and use some of it to pay dividends. So it's not either or, typically. Okay, now for the sort of the decisions regarding whether and how a company pays dividends. I've written down a sentence here that I want to complete with you. Namely, dividends may be paid by the business either regularly, and typically, depending on country, regularly may mean quarterly, it may mean semi-annually, so once every 6 months, or in some countries, there is the tendency to pay a dividend once a year, so on an annual basis. And some businesses do indeed pay regular dividends. Others do so on a more sort of ad hoc basis when they feel the situation is right. So that's going to be an occasionally over here. Or, in fact, not at all. There are companies which don't pay a dividend at all to their shareholders. And you may think that's terrible, and such shares should be shunned, should be avoided. Well, that's not necessarily the case, because if the company has good growth opportunities in-house, then probably it's a better idea to keep reinvesting in the money into the business, making the company therefore grow on those sort of investment opportunities, and the investors, the shareholders, will not be worse off from that, because whatever they don't get as dividends in the form of cash, they get from share price growth as the company develops and grows, and probably the rate of the share price growth is going to be higher than than the yield they would generate if they were just receiving a dividend, providing the company does have profitable business opportunities for growth. Now, what are going to be some of the key factors, or what is going to be the key factor that determines how a company pays its dividends? On what kind of basis, in what kind of amount? So what we call basically dividend policy. Well, the main determinant and driver here is definitely going to be the stage at which the company is in what we call the company life cycle. In the company life cycle, that's going to be the critical determinant of how most companies pay, or indeed do not pay, dividends. If you come across a startup or a company which is still in the sort of growth phase, then it's typical to expect that such a company will not pay dividends. So typically, such businesses do not pay dividends. Why don't they do so? Well, A, they may not have a profit yet. They may not be profitable, which is definitely true for the majority of startups. But once they're in the growth phase and they are already potentially making a profit, whatever profit they have will typically get reinvested. So the earnings they produce, once they do produce positive earnings, and the cash flows they produce, the positive cash that they produce, are going to be typically retained within the business. That term again, retain, i.e. kept in the business, and reinvested to allow the business to grow without asking the shareholders for more and more capital. Now, it's going to be very different for companies that are already mature. Typically, such companies do not have so many good, profitable reinvestment opportunities or growth opportunities, and such businesses typically do pay dividends. And the reasons for that is that they are already stable, they've got stable cash flows. They're not reinvesting so much. They are, of course, reinvesting. There is some capital expenditure. Even if a business is not necessarily growing, you still need to replace certain property, plant and equipment, certain facilities, etc., etc. But there's far less of growth going on than is the case with startups and growth stage companies. Now, the final bit of this video is going to be all about what happens when a company is liquidated, because obviously, and what we talked about so far, namely dividend payments, is kind of business as usual. The business is functioning, paying dividends. The assumption is it's profitable and hence can afford to do so. But what if a company goes into liquidation, i.e., ends up being wound up? Well, the assets of the business, namely, the resources that a business controls, or things of value that a business possesses, are going to be used to cover first any liabilities that the company has. And, when we think about liabilities, these are obligations to pay money back typically. So this will include any debt that the business has taken on. And of course, if a company has taken on debt, it has a contractual obligation to repay capital plus interest. And that, has to be done first. Whatever assets there are have to first be used to cover the company's debts. So here, by saying that this is the first step, we're basically taking into account, or yes, absolutely observing what's known as a hierarchy of repayments. And only after all the liabilities have been covered, not just debt, but tax obligations, obligations towards consumers, obligations towards authorities, obligations towards employees, any contractual obligations that there may be, anything that's left, and I'm going to call this the residual. Now, there's no guarantee that there will be anything left. The residual or net assets of the business. Net assets are assets minus liabilities. Only then can these net assets be attributed and shared among the shareholders. They are attributable to the shareholders. In fact, when people define equity for legal purposes, or maybe very often for accounting purposes, in accounting, equity is an instrument that gives you a residual interest in the net assets of the business. Now, there'll be more on that later on as well in subsequent videos. But for now, let's say that what we've discussed above, namely the fact that equities typically generate some kind of periodic discretionary distribution to shareholders, although without any contractual obligation on the part of the company to do so. But the fact that many companies do pay dividends gives shareholders the right to a dividend. Not an enforceable right, but the fact that they may receive a dividend, and also what we call liquidation rights, i.e., the fact that they get a stake, a portion of the net assets of the business, the residual of the assets after liabilities have been paid off. These are what the book describes as examples of so-called economic rights. So shares, equities, give shareholders, equity holders, certain economic rights. Dividend rights, and liquidation rights. On top of that, or going further, shares also give their holders certain very important voting rights. And voting rights, it's basically about the right to vote, isn't it? So this is the right to vote, and by casting a vote, participate in what we describe as corporate governance decisions. Decisions concerning things like the election of directors in the business, the election of auditors, the remuneration policy for the board of directors. These are all parts of what we call corporate governance. Now, at this stage, at the very end of the first video, we're going to introduce an important split. Shares or equity instruments are not uniform. They come in at least two varieties: ordinary shares and preference shares. And a major distinction between these, which we will be covering in the subsequent videos, is the eligibility to vote, i.e. voting rights. You see, voting rights are typically enjoyed by holders of what we call common or ordinary shares only. So it's common or ordinary shares. Shares can also be described as stock. So ordinary shares, common stock means the same thing. Two ways to describe the fact that they're ordinary, and two words to describe the fact that they are shares. It's typically only the common or ordinary shareholders who enjoy voting rights. At the same time, we also have many companies that issue preference shares. Not all do so, but some do, especially the bigger ones. And the holders of so-called preference shares which may also be referred to as preferred stock. You see, these shareholders, despite also being shareholders, but preferred ones, they do not have voting right, typically. That's a major important distinction, and we're going to talk a lot more about preference shares and ordinary shares and the differences between them in the subsequent video.